Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have completed the meaning of the term financial statements and what is financial statement analysis, what is the importance and what is the need of financial statement analysis. Actually, last video I've started the new subject accounting for management for MBAs. So in this unit number 3 that consists of financial statement analysis including ratio analysis and common size statement analysis. These are the topics I'm going to cover up in the next few videos. The last video I've completed. Now in this video I'm going to explain you about managerial uses of financial statement analysis. How the managers are going to use this technique of financial statement analysis. Apart from that, what are the different techniques? There are different techniques of analyzing the financial statements. What are those techniques? I'm going to explain. Next one, what do you mean by ratio? What is ratio analysis? What is the objective of ratio analysis? And what are the users? Who are the users of financial statement analysis? These are the topics I'm going to explain you in this video. So remember, the theory is very, very important. If a student is conceptually clear about the meaning, then he can be able to solve the problem. Because in this, not only we have to make the calculations, but also we have to give the interpretations. The interpretation you can give only when you know the concept. That's why this theory is very important. Don't skip in between and don't join. So if you want the perfect knowledge, watch the first video, be clear regarding the concept of financial statement analysis, what is the need and importance in the last video. If you have not watched, I suggest you go to the playlist of my channel, select the subject accounting for management, select the video of financial statement analysis, be clear, then you come to this video. So before proceeding, take the screenshot of the points which I have written on the board, then I explain all the points in detail. So first of all, what are the managerial uses of financial statement analysis? How the managers can make use of this technique of financial statements. Now, financial statement analysis depicts financial results which are useful in identifying the progress of a business. The managers have to evaluate how the business is performing. What is the performance? How is the performance of the business? To find out that, managers will use this technique of financial statement analysis in order to take the decision, in order to evaluate the financial performance. Secondly, trend analysis as a technique of financial statement analysis. In financial statement analysis, many techniques are there. One of the technique is trend analysis. By studying this trend analysis, the management can be able to find out what is the changes, what is the directional change, what is the directional change of the performance of the business. Remember, the performance will not be stagnant. Sometimes there will be growth, sometimes there will be decline in the business. So whether the business is showing a growing trend or a declining trend, this can be known by using trend analysis, which is one of the technique of financial statement analysis. Next one, profitability and financial strength of the business can be ascertained through comparative analysis with competitors or industry average. It helps in planning for next year. Comparative analysis. This is also one of the technique of financial statement analysis. By applying this comparative analysis, a business can be able to compare its own performance with the industry or its own performance with the competitor's performance, so that the business can be able to make some planning, how to grow, how to improve the business financial performance only by comparison. We can be able to do this, and comparative statement analysis is one of the technique of financial statement analysis. Next one is long-term investors. Basically depends on fundamental analysis which is essential part of financial statement analysis. One of the part of financial statement analysis is fundamental analysis. That means analyzing the financial performance and the financial, position of the business. So any long-term investors, before making the investment, they will analyze these financial statements to find out the financial position and financial results. In this way, it will be useful to long-term investors. Then financial statement analysis helps the users of financial statements to take prudent decisions. One of the main application of this financial statement analysis is it will help the user in taking a prudent decision. Without having information, we cannot be able to take the decision. And this financial statement analysis will generate the information which will be helpful to the user. Here the users are managers, so that they can be able to make prudent decisions. Next one is financial statement. By applying financial statement analysis, managers can be able to analyze the past and can make future projections. Planning is the first function of management. Planning means deciding about the future, what we have to do, how we want to do. All these about future planning can be done only with the help of analyzing the past. By analyzing the past, we can make future projections. So this financial statement analysis will be very much helpful to the managers in analyzing the past in order to make future projections. So these are few uses of financial statement analysis by the managers. Next topic is techniques of financial statement analysis. See here, there are many techniques of analyzing the financial statements. Few important techniques are, first one, comparative analysis. In comparative analysis, we compare the performance of one period with another period. For example, current year's performance, we are making comparison with the past year, last year and current year. Whether current year is the performance has improved or deteriorated compared to the last year. So without comparison, we cannot be able to know how we are growing. Our business is growing or declining. We cannot know until unless we compare it. So comparative analysis is one of the technique of financial statement analysis. Secondly, common size statement analysis. In common size statement analysis, we condense the data by calculating percentage. Each and every item of profit and loss account and balance sheet, we express as a percentage of the base item. The base item in profit and loss account is sales. So we calculate all other items as a percentage of sales. Simple example, in case of trading profit and loss account, the gross profit is 2 lakh. The sales are 10 lakh. So instead of saying that gross profit is 2 lakh and the sales are 10 lakh, we can express it as a percentage. 2 lakh divided by 10 lakh into 100, 20%. So simply we can say the gross profit is 20% of sales. Like this, we calculate all the other items as a percentage of sales. In this way, instead of taking the actual values, we have converted the actual values into percentages. And that type of analysis is called common size statement analysis. What will happen by applying this common size statement? The data will be condensed. Easily we can be able to understand and analyze the statement of profit or loss and the balance sheet. Next is trend analysis. This is also one of the technique of financial statement analysis where we find out the trend or directional change over a period of time. Example, current year, 2023. So we want to find out what is the trend of our performance over the last few years, last 5 years suppose. So over the last 5 years, our directional change is what? How our performance is changing? Is it increasing trend or declining trend or remaining constant or fluctuating? That information we can get by applying trend analysis. So in trend analysis, we take the first year as base year and calculate the percentages of all the other values as a percentage of base year. So we are comparing all the figures with the base year to find out whether our business directional change, whether it is increasing or declining. Next one is funds flow analysis. This is also one of the technique of financial statement analysis, where we find out the changes in funds. Funds means working capital. Whether working capital has increased or decreased compared to the last year. That means what are the changes taking place in assets and liabilities over a period of time. So last year balance sheet and current year balance sheet, do you think that the values of assets and liability will be same? No. The assets and liability values will get changed from year to year. So a business organization wants to find out what are the changes in the assets and liabilities by calculating changes in working capital. That is called funds flow analysis. Here the meaning of the term fund is working capital. Changes in working capital. This funds flow analysis is also called statement of source and application of funds. What are the sources from which fund has been received, and what are the application areas where fund has been deployed? So this is called funds flow analysis. Next comes cash flow analysis. The next unit number 4, I'm going to explain you in detail about this cash flow statement. But cash flow statement is also one of the technique of financial statement analysis, in which we find out what are the inflows of cash and what are the outflows of cash during a period of time. So the cash flows will be through operating activity or investing activity or financing activity. So in this way, we divide all the activities of the business into operating, investing and financing. So what are the sources from which there is inflow of cash and outflow of cash in operating activity? Similarly, inflow of cash and outflow of cash in investing activity. Lastly, inflow of cash and outflow of cash in financing activity. So all these cash inflows and cash outflows during a period of time can be ascertained by applying cash flow analysis. Next comes ratio analysis. In this unit, in this video only, I am going to explain you this ratio analysis. It's a technique of expressing relationship between two variables. And this ratio analysis is very widely used technique of financial statement analysis. Very important technique which is used throughout the world in every organization. We use ratio analysis, right? Next one is cost volume profit analysis. This is one of the technique in cost accounting where we make a relationship between cost, volume and profit. By applying this, a number of managerial decisions can be taken regarding at what point, at what level of activity the business will neither get profit nor loss. What is the level of activity at which the business will get a desired profit? How much are the sales required to earn a desired profit? Similarly, product mix decision. Similarly, whether the business should be continued or shut down. Or the next is make or buy decisions. All these managerial decisions can be applied by using CVP analysis, cost volume profit analysis, which is one of the technique of financial statement analysis. So these are the few techniques of financial statement analysis which are widely used. Now, ratio analysis. This is the most important technique of financial statement analysis. Ratio analysis. First of all, the meaning of the term ratio. The ratio is a mathematical technique of expressing relationship between two variables. That means a single variable will not convey much meaning until and unless we compare one variable with another variable. Simply, we can't say if a student scored 30 marks, we cannot say whether the student is a good student or bad student or average student or excellent student or genius. We cannot be able to say. If we just have the information, he got 30 marks. Until and unless we compare this 30 marks with the maximum marks. If 30 marks he got from 100 marks, he is a failed candidate. Very bad. If out of 50, he got 30 marks, it comes to 60%, a good student. Suppose if he got 30 out of 40, that means 75%, excellent distinction. Suppose if he got 30 out of 30, 100%, genius. So until and unless we compare the actual marks with the maximum marks, we cannot come to the decision. What I want to say, a single value will not convey much meaning until and unless one value is compared with, related with another value. So this ratio analysis is a technique of expressing relationship between two variables. Like in profit and loss account, in balance sheet, so many variables are there. We make a comparison. Example, we make a relationship between gross profit and sales. Gross profit 2 lakh, sales are 10 lakh. So simply we can say what is the gross profit ratio? Gross profit by sales into 100. 2 lakh divided by 10 lakh into 100, 20%. So simply we say the gross profit is 20%. What does it mean? For every 100 rupees of sales, 20 rupees is the gross profit. Like this we are making a relationship. Similarly, current assets, current liability in balance sheet. The current assets are 2 lakh. The current liabilities are 1 lakh. So we can make a ratio, current assets by current liabilities. 2 lakh divided by 1 lakh, 2:1. We calculate the ratio, 2:1. What does it mean? The current assets are double the current liabilities. Like this relationship we are making among different variables in the financial statements. That is called ratio. Now ratio analysis. Ratio analysis is the process of calculating the ratios, analyzing and making interpretation. One point you remember. Simply calculating the ratio is not the end of the matter. After calculating the ratio, we have to analyze all the ratios. We have to give the interpretation of the ratios. That is called ratio analysis. So ratio calculation is only a part of ratio analysis. So after calculating ratio, we have to analyze the ratios, we have to give the interpretation of ratios. That is called ratio analysis. So ratio analysis is a technique for calculating the ratios, analyzing it and making interpretation thereof. It is process of establishing and interpreting values, ratios to help in decision making. So why we calculate ratios? First of all, we calculate the ratios by making a relationship between different variables. After calculating the ratio, we analyze it. After analyze, we give the interpretation or conclusion. Why we give the interpretation? So that this interpretation will be useful in taking the decisions. Finally, the ratio analysis technique will be applied in order to take the decisions. It is a very important tool which is used to measure financial performance of the firm. So most of the firms will apply this ratio analysis in order to evaluate the financial performance. Now comes to objectives of financial ratio analysis. Why ratio analysis will be used? Many objectives are there. The first objective is comparison of past data. Every organization wants to compare its current year performance with the past year performance to find out whether current year we are growing or declining. So in order to make the comparative analysis of current year with last year, we use the ratio analysis. First objective. Second, comparison of one firm with another firm. This is called inter-firm comparison. Normally, every business wants to find out our own performance with the competitor's performance. Another firm. There is a lot of competition in the market. So many competitors are there. So one company wants to compare its own performance with another company, its competitor. Ratio analysis will be used in order to make the comparison. So first one is called intra-firm comparison within the same firm, one year with another year. Second one, inter-firm comparison, comparing one firm with another firm. Third one is comparison of one firm with the industry. Industry means a group of companies producing the same product. Producing the same product, a group of companies makes the industry. Example, textile industry, sugar industry or IT industry, like that. It's a group of companies. Now every company in the industry wants to compare our own performance with the industry average. In the industry average, again ratios will be used to compare the company's performance with the industry average. Next one, comparison of an achieved performance with the predetermined standards. Nowadays, a number of standards are made. That means planning is made. Plans are prepared. For example, next year, how many units we must produce, how many units we can sell. All the planning we have made. Budgets we have prepared. After preparing the budget, we compare the actual performance with the standard performance or budgeted performance. So again, for comparing the actual performance with budgeted performance, we need the ratios. It will be used. Next, comparison of one department of a concern with another department. Nowadays, many companies are producing different products, having different departments. So company is interested in comparing the performance of one department with another department in the same organization. Ratios will be used for comparing the performance of one department with another department. Simple example, LG company. LG company produces so many products. Now they want to compare the performance of suppose electronic items like LED or refrigerator. Both are produced by LG only. Now LG wants to compare the performance of LED production with refrigerator production. Ratios will be used. So these are the objectives why we use ratio analysis. The last topic are users of ratio analysis. Who will use? So many users are there of ratio analysis. First of all, ratio analysis is a technique which is used to evaluate the financial performance or financial position of a business. Now the following are the various users. First one, management. The biggest user of ratio analysis is management. Because management has to take the decision. Management has to evaluate the performance. Management wants to find out the strength and weakness of the business. Management wants to evaluate the efficiency of the business. For all these purposes, management will use ratio analysis technique. So, first one, ratio analysis helps management in many ways, assessing financial position of a firm to make necessary decisions. Time to time, the management has to evaluate the financial position of the business, the worth of the business, value of the business to take the decisions. Secondly, facilitate in financial forecasting and financial planning. Every business organization, the main function of management is planning, forecasting. For making this planning and forecasting, the managers will use ratio analysis technique. Next, third one, helps in communicating the financial strength and weakness. Every management wants to find out what are the strength and weakness of our business so that we can be able to maximize our strength and minimize the weaknesses. Next one is helps in coordination of activities. When the business grows, the activities will also grow. So until and unless we coordinate all the activities, the objective of the organization cannot be achieved. So coordination is a big problem. Ratio analysis will be very much helpful to the management for coordinating the activities. Next one is facilitates an effective control of the business by revealing the loopholes in it. Every business will have a number of loopholes. The management has to rectify, correct the loopholes. So by using this ratio analysis, the management can be able to recover these loopholes, remove these loopholes to make business more effective. So these are few application areas where managers will use ratio analysis. Next, investors or shareholders. Every investor or every shareholder is also interested in calculating ratio analysis. Because by calculating ratio analysis, the investor, the prospective investors can be able to know what is the strength of the business, what is the profitability of the business, what is the solvency of the business. If I invest in this company, in this firm, will my money will be safe or not? Can I be able to get the profits or not? Sufficient profit I can be able to get it or not? So before making the investment, the investor shareholders wants to analyze the performance by using ratio analysis. So next one is creditors or suppliers. The creditors means suppliers, those who supply the material. The creditors are also interested in the business. How? Because they are supplying the goods on credit and they should be assured that their money will be returned by the company on time. So before supplying the goods, the supplier will see what is the liquidity position, what is the solvency of the position. If the business solvency liquidity is good, the supplier will come forward to supply the material. Again, the suppliers, creditors will make use this ratio analysis in order to evaluate the liquidity solvency of the business. Next comes employees. Nowadays, employees are also interested in the performance of the business because if a firm's financial strength is good, if the firm's profitability is good, then the firm will be able to pay good salary, good remuneration, good promotional opportunities, job security. All these things will be there to the employees if the financial performance is good. So employees wants to see what is the financial performance of the company. They will use ratio analysis in order to evaluate the financial performance. Lastly, government. The government is also interested in the financial performance of the business because the government will implement the tax. The government will make the policies and plans how much tax should be applied on which type of industries so that the revenue should be increased and also there should be some motivation on the part of the industry. So government will make use the ratio analysis in order to make the policies, make the plans and for taxation purposes. So these are the few users of ratio analysis. So students, in this video I have explained you the managerial uses of financial statement analysis, the techniques of financial statement analysis, what is ratio and what are the ratio analysis, and what are the objectives of ratio analysis, and who are the users of this ratio analysis. Inshallah, we'll continue our discussion in the next video.